Welcome, ladies and gentlemen, to segment 2, part 1 of the Cima strategic case study, Financial Strategy, or F3 Essentials Refresher. Why I call this segment 2, part 1 is because this is financing. This is about the financing decision, and I have actually divided it into two parts, where in the first part we talk about debt and equity, and in the second part we talk about capital structure. So let's go on with part 1. Have a look. But before we deep dive into the content, I have to remind you of the few things that you need to prepare yourself with. Please have a notebook and pen on the ready. Do follow the slides and my explanations very carefully. Take notes, maintain a list of doubts and clarifications. Do maintain a list of key topics that you feel you're weak at, so you can self-revise later, or even pause, use the pause button effectively and revise then and there itself. Make sure that you stay focused. On that note, we can briefly look at the core activity as a reminder and see this first area, evaluating the suitability of sources of finance. This is what Cima expects of you. You should be able to evaluate the suitability of sources of finance and even really determine the structure of financing you will use for a project or your company itself. And that is where the financing decision segment 1 on debt and equity comes in. Sources of finance. Now, the financial manager must possess a good knowledge of the sources of available funds and their respective costs, and should ensure that the entity has a sound capital structure, that is a proper balance between equity capital and borrowings, which fundamentally make up the sources of finance. Now, such managers also need to have a very clear understanding. Now, when I say such managers, financial managers, we are talking about the SCS company role that you are assigned in your pre-scene, right? Financial senior manager finance. This is what we've been seeing continuously, right? Such managers also need to have a very clear understanding of the difference between profit and cash flow, bearing in mind that profit is of little avail unless the entity is adequately supported by cash to pay for assets and sustain the working capital cycle. So profits, sure, we have to be profitable, because without profits obviously you're not going to make money, but the profits have to be translated into material cash flows. This understanding is important. Financing decisions also call for a good knowledge of evaluation of risk. Excessive borrowing carries high risk for an entity's equity because of the priority rights of the lenders. So shareholders wouldn't really prefer too much if we go for lenders, because the more leveraged the company is in terms of debt, it means that the lenders take naturally more priority in the case of concern in terms of a going concern ability or a winding up or a bankruptcy declaration, and that is really not something equity owners would want to deal with. The capital, now we need to then, right, with all this knowledge, with all this understanding of what a financial manager is supposed to be good at, we have to figure out where can I get the money, right? Where can I get the money from? So you have a few places. One is obviously the capital markets, where new share issues, for example, by companies acquiring a stock, market listing for the first time, rights issues of marketable debt, example, even bond issuances, right? This is a market where money is available to tap into, right? If people like you, they will give you money, right? Then you have bank borrowings, financial institutions who fundamentally one of their key functions is to provide money. So long-term loans or short-term loans, including bank facilities such as revolving credit facilities and money market lines and even OD facilities, all of these can be in terms of bank borrowings. Venture capital funds. This is high risk finance provided by specialist organizations. The main problem is that the providers of VC funding tend to demand significant equity participation in a company and will also want to influence the policy of the company, right? These VCs are extremely, you have to be very careful and smart to deal with them in a way that doesn't compromise where your company wants to go, because if the moment if the deal is set up in such a way that they have high amount of control, things can be tricky to manage. Government and similar sources, right? You can get grants, subsidies, donations, tax breaks, etc. Right? So these are various sources of finance, sources of funding that you can tap into. In general, finance can be raised through debt or equity. And this is where we were hoping to get to, weren't we? Now, before we specifically look at debt and equity, we have to understand the different financing considerations. So if you are looking for money, there are factors to consider when deciding whether debt or equity should be used. For example, now not even for example, some of these factors, or almost all of these factors, are mentioned here in this slide. Pay attention. One of the factors is obviously the cost of financing, right? Cost of the different sources of finance. Then the duration, for how long is finance required. Lending restrictions, for example, any security and debt covenants that are already in place. The gearing level, also well known as the capital structure, which we will look at in segment 2, part 2. Liquidity implications, the ability of the business to service the new debt. The currency of the cash flows associated with the new project, if at all. Impact of different financing options on the financial statements, tax position, and financial stakeholders of the entity. So these are key financing considerations before you decide whether to go with debt or equity. And that brings me to financial risk. There are two elements that make up the risk associated with a company. So we do take a closer look at financial risk management, but on the offset, when you look at it from a helicopter view, you have to understand that financial risk is made up of two components. One, unsystematic or specific risk. This is the risk of the company's cash flows being affected by specific factors like strikes, R&D successes, systems failures, etc. Right? So you have unsystematic risk. Then you have systematic or market risk. Is the risk of the company's cash flows being affected to some extent by general macroeconomic factors such as tax rates, unemployment, or interest rates, right? So you have unsystematic risk and systematic risk. By holding a portfolio of investments, the unsystematic risk is diversified away. So you can diversify this by holding a portfolio, a diversified portfolio of investments. So you have money invested in the tech sector, the renewable energy sector, you have money in the agricultural sector, you have in the apparel sector. So you've got a portfolio. So when one sector is doing poorly, another sector can do well, and that diversifies off or minimizes your risk. So the unsystematic risk is diversified away, but the systematic risk is not, and so will be present in all portfolios. This is how it usually works. Number of shares in a portfolio and the diversified nature of the portfolio, as it is more and more, you will notice that your unsystematic or specific risk is getting diversified to almost, not exactly zero, but to almost very minimal levels, whereas the systematic risk will always be there. This is one reason why we set the beta at always 1, right, where the market risk is inherently always there. We will look at beta factor as we go forward. So those are the two elements that make up the risk associated with a company. Let's take a look at capital markets now. Capital markets have two main functions. The primary function is to enable companies to raise new finance, either equity or debt, right? There are debt markets also. Through the stock market, a company can communicate with a large pool of potential investors. So it is much easier for a company to raise finance in this way rather than contacting investors individually. But the secondary function is also a very important function. This is to enable investors to sell their investments to other investors, right? So it's sort of this exchange facilitation. A listed company's shares are therefore more marketable than an unlisted company's, which means that they tend to be more attractive to investors. And so these are the two key functions of the capital markets, which was the first point under sources of financing we looked at. Now let's take a look at equity and debt. First of all, equity financing. Now, equity financing is purely just simple ownership, and we can start by looking at the key components. You have obviously the shares aspect to it. There are ordinary and preference shares. You also have private placements. You also have the rights issue aspect. Now, these are three means. Placing, rights issue and IPOs are the three means of securing equity finance, right? And shares is the medium of how that financing is translated to ownership. What are the key terms? Obviously, we have to understand important terminology. So, equity is another name for shares or ownership rights in a business. Now, a share is a fixed and identifiable unit of capital in an entity which normally has a fixed nominal value. A fixed identifiable unit of capital, right, in an entity which normally has a fixed nominal value which may be quite different from its market value. Shareholders receive returns from their investment in shares in the form of dividends and also capital gains on the share price. Whereas ordinary shares pay dividends at the discretion of the entity's directors. So the directors have discretion or the decision making power of what level setting up dividend policy, so to speak, which will be another segment altogether. The ordinary shareholders of a company are the owners of the company, and they have the right to attend meetings and vote on any important matters. On a winding up of a company, the ordinary shareholders are subordinate to all other finance providers. So in fact, ordinary shareholders are the ones who face the maximum amount of risk, especially in the case of a winding up. That is, they receive their money last, if there is any left, after all other finance providers have been paid. Right? It's a high risk, high return game to be an ordinary shareholder. So I would say Warren Buffett is one of the smartest ordinary shareholders in the world. Right. That brings us to also a quick look at preference shares. Now, preference shares are a form of equity that pays a fixed dividend, which is paid in preference to before ordinary share dividends, hence the name. So they are little above in terms of preference, a little above ordinary shareholders. And on a winding up of a company, the preference shareholders are subordinate to all the debt holders and creditors, but receive their payout before ordinary shareholders. So they're right there in between the debt and other creditors, and below the line or below them, you have the ordinary shareholders. So these are preference shares, and really in terms of returns, instead of making a risk-based dividend policy-based return, they earn a fixed dividend. That brings me to the listing aspect, right? What do you do? How do you become a listed company? And in almost all cases, the strategic case study also involves a listed company. Now, a stock exchange listing when an entity obtains a listing or quotation for its shares on a stock exchange. Now, this is referred to as a flotation or an initial public offering, right? When it's done initially, IPO. Advantages of listing, right? What are the good things when you become a quoted company? Once listed, the market will provide a more accurate valuation of the entity than had been previously possible. Realization of paper profits and mechanism for buying and selling shares in the future at will, right? Raises the profile of an entity. Your reputation goes up, which may have an impact on revenues, credibility with suppliers and long-term providers of finance. It's also one that leads to the opportunity to raise capital for future investment, makes employee share schemes more accessible. But it also comes with a bunch of disadvantages, right? The disadvantages of a listing: it's costly for a small entity, flotation, underwriting costs, etc. Making enough shares available to allow a market, and hence loss of at least some control of the original owners. Reporting requirements are more onerous and very detailed and demanding. You have to comply with a lot of regulations. You have to comply with SEC regulations. Stock exchange rules for obtaining a quotation can be stringent, right? There are, in terms of size, scale, ability to deal and trade, and in terms of security itself, there are stringent requirements, especially in stock exchanges like the New York Stock Exchange, or even the London Stock Exchange, Singapore, Hong Kong, China. There are extremely stringent rules in place, or requirements, prerequisites in place for you to be a listed company. The three most commonly used methods of issuing shares, therefore, one is obviously the IPO, the initial offering or flotation. B is a private placement, and C is a rights issue. If a company has already a listing on a stock market, then the company will either raise new funds by means of a rights issue or by means of a placing. An IPO is more suitable when a company seeks a listing on the stock exchange for the first time. And that brings me to what a rights issue is. Now, implications of a rights issue. From the viewpoint of shareholders, they have the options of buying shares at a preferential price. So you're offering shares to existing shareholders at a better price, at a preferential price, where they have the option of withdrawing cash by selling their rights, right? So it's only if they decide to execute their rights, they can get the shares, or they always have the option of withdrawing cash. They're able to maintain their existing relative voting position by exercising the rights, right? So you're not selling you're not providing shares themselves, but you're providing the right, the rights. What has been issued is the rights to either either sell the shares or convert those shares into cash, or to retain the voting position. But from the viewpoint of the company, this is a simple and cheap method to implement, and usually successful, because a company would go for a rights issue only if it's comfortable, and only if the shareholders are already in the company's corner, so to speak, and it often provides favorable publicity. So what are the courses of action open to a shareholder when a rights issue is offered? You can obviously do nothing. Shareholders may be protected from the consequences of inaction by the company selling the rights on behalf of inactive shareholders, right? So you can just keep calm and just wait to see what happens. You can renounce the rights and sell them on the market, right? So you obviously have a capital market position here, and you can sell them on the market. You can exercise the rights, that is, buy all the shares at the rights price, right? So this is what will happen if you decide to use your rights. You can renounce part of the rights and take up the remainder. So you can be partial about it, right? 50% you exercise, 50% you renounce it. These are the, I would say, ideally 4 options available for a shareholder, and this is existing shareholder we are talking about, right? We are not talking about new shareholders. We are talking about existing shareholders who already have a certain amount, and on their ownership proportion, these rights are being provided. And that brings us to debt financing. So debt is, of course, quite self-explanatory. Debt is something that countries and families associate themselves with a lot. So there are, in classifying debt, there are 2 types of debt: bank borrowings and bonds. Whereas in terms of debt finance, some of the considerations you have to put into is obviously the risk element. And you can also, in terms of, because you would go for debt to acquire assets, right? So you always have the lease or buy option to think about when it comes to securing debt finance. Types of debt finance. So you have the bank finance option, or the type for companies that are unlisted, and for many listed companies, the first port of call for borrowing money would be the banks. These could be the high street banks, or more likely for larger companies, merchant banks. Terms and conditions are negotiable dependent on the term of the borrowing, the amount borrowed, and the credit rating of the company wishing to make the borrowing, obviously. Then you have the capital markets. As an alternative to borrowing funds from a bank, a listed company may issue bonds or short-term commercial papers in the capital markets, and people could subscribe to buy those bonds, and they don't provide ownership, right? They just provide financing and a fixed return for whoever the financiers are, right? They don't get ownership, unlike what happens with equity shares. Then you have international debt finance, where large companies can borrow money in foreign currencies as well as their own domestic currency from banks at home or abroad. The main reason for wanting to borrow in a foreign currency is to fund a foreign investment project or foreign subsidiary. Right? So you have bank finance, banking finance, capital markets, and international debt finance. Now, one of the most important aspects when it comes to debt finance is credit worthiness, right? You cannot get or even ask for debt if you are deemed to be not credit worthy or unworthy of credit. To assess credit worthiness, there are different elements that are looked at, especially by a bank. For example, or rather the key areas that a bank would look at or a financier would look at. One, they would analyze or analysis of a business plan. The lender will perform a detailed analysis of the business plan presented by the potential borrower. This will include detailed ratio analysis of the potential borrower's recent accounts and forecasts. Then business prospects of the potential borrower. Further analysis in an attempt to build up an independent assessment of the prospects of the borrower. Then the security available, right? The collateral. The lender will look at the statement of financial position of the potential borrower to assess whether there are assets that could be used to provide security for the borrowings. Lending the money secured on assets of the borrower would significantly reduce the risk to the lender, right? Then obviously the credit rating of the company. The credit rating of the borrower is also an important factor. An entity with a poor credit rating will find it more difficult to borrow money. If the lender does decide to lend, a higher interest rate would be charged to compensate for the risk taken on by the lender. Then you have other borrowings and covenants, right? Is the company already leveraged? The risk to the lender will be higher if the potential borrower is already highly geared and has debt covenants attached to its existing borrowings. And also an analysis of capital structure and gearing. The ability to satisfy debts falling due after 1 year. There are two elements to consider: the ability to repay the capital and of course payment of interest. Right? So if you were to assess credit worthiness, or if you were to get a question on the SCS about the potential for the company to acquire debt financing, these are the key aspects that the lender would look at: your business plan, your business prospect, security, credit rating, any other borrowings and covenants, any previous other commitments, and an analysis, a thorough analysis of capital structure and gearing, for which we have a complete segment dedicated. And that brings me to the profile that we need to consider when it comes to debt financing. So the idea here is that a company should aim to achieve an optimal target debt profile. Right? Once an entity has decided how much debt finance is needed, several issues need to be considered as the entity aims to achieve its target debt profile. What are these considerations? Should the entity borrow at a fixed or floating rate? Should the debt have a short-term or long-term repayment date? Should domestic currency or foreign currency borrowings be used? Now, the answers to these questions will determine the level of interest rate, refinancing, and currency risk that the entity will face. So on top of the initial question that, whether we need to go for debt or not, on top of that, once you determine that debt is where you want to be at, you have to think about the interest rate, the repayment time duration that you're willing to deal with, and the kind of currency, right? Especially if you have access to foreign currency debt, you might definitely take a look at those as well. In addition to that, you can tap into other sources of finance. You should take a look at your retained earnings and any existing cash balances, any options of sale and lease back, right? If you have assets which are ones that have value and they could be sold to acquire a certain amount of cash, and any lease back options, any grants, any debt with warrants attached, convertible debt issuances, venture capital, business angels, and any government assistance, right? So these are all essential elements to look at because you are trying to establish an optimal debt profile, right? You don't want to be overly leveraged. You don't want to be in a position where the company cannot bear its repayment and interest. You don't want to be in a position where your credit worthiness is put at stake unnecessarily, right? You don't want to be in a position where you take unnecessary risk. That is why these questions are very, very important, and they fall directly under the scope of effective, smart financial management, which is the primary responsibility of a senior manager in the finance function, as the strategic case study demands. That brings me to the key considerations under debt finance. Obviously, the first one is tax consideration, and wonderfully, debt is a tax efficient form of financing because interest is paid out of pre-tax profits as an expense of the business. Therefore, paying interest reduces the taxable profits of the business and hence the tax payable. This means that the cost of servicing debt from the company's point of view is cheaper than the stated rate of interest on the borrowing, because interest is, well, in simple terms, interest is supposed to be tax deductible. That's why when you even calculate the cost of debt, even for a loan, you multiply your interest rate into 1 minus t, right? That is to eliminate the tax because it is tax deductible. It's cheaper than the stated rate of interest on the borrowing. That brings me to another key consideration, covenants. A further means of limiting the risk to the lender is to restrict the actions of the directors through the means of covenants. These are specific requirements or limitations laid down as a condition of taking on debt financing. So, what are these different elements we would look at? Do you have any dividend restrictions, right? Limitations on the level of dividends a company is permitted to pay, right? So, the bank will ideally, if they perceive you to be high risk, if they have concerns about the interest commitment, they will want to establish covenants before they give out a loan. It is designed to prevent excessive dividend payments which may seriously weaken the company's future cash flows and thereby place the lender at greater risk. Then you look at financial ratios, right? Banks look at financial ratios. Specified levels which certain ratios may not breach. Example, minimum interest cover, maximum gearing ratio, minimum EBITDA, and finance costs. Then covenants by means of financial reports, like regular accounts and financial reports have to be provided to the lender to monitor progress. Then issuance of further debt, the amount and type of debt that can be used may be restricted by means of either subordinated debt. Debt ranking below the existing unsecured debt can usually still be issued. So you know that this is generally known as mezzanine finance, right? Subordinated debt, because debt also has as the society does different classes of debt, right? So class A and then subordinated debt, etc., etc. So even banks would even determine that we would not release the entire loan amount, but we would release it in stages, right? That would be determined using some sort of covenant based agreement. Another key consideration is securities. Now, the lender of funds will normally require some form of security against which the funds are advanced. This means that in the event of default, the lender will be able to take assets in exchange of the amounts owing. There are two types of charge or security that may be offered or required. So, there can be a fixed charge or a floating charge. Now, a fixed charge is where the debt is secured against a specific asset, normally land or buildings. Right? This form of security is preferred because in the event of liquidation, it puts the lender at the front of the queue of creditors. Right? Whereas a floating charge is where the debt is secured against the general assets of the business. This form of security is not as strong. Again, it confers a measure of security on liquidation as a preferred creditor, meaning the lender is higher in the list of creditors than otherwise. So, when the asset or when what you are using as security is well known and is fixed, you use it as a fixed charge, but your either things like the reputation of your, well, in tangible form, right? You have to prove it in some sort of tangible form, your sales ledger, these kind of things, when they are used as security, you call it a floating charge. Those are key considerations when it comes to acquiring debt finance. And that brings me to a little area but important area, the link between credit ratings and interest rates. So you did hear that we talked a lot about credit rating, and every company gets assigned a credit rating. An entity rated AAA by Standard & Poor's, S&P, is a very low risk investment. You would have seen that during COVID-19, a lot of countries, a lot of companies got downgraded in terms of their credit rating, and you have the major credit rating agencies. You have S&P, Standard and Poor, then you have Moody's, for which I used to be an analyst in the investment banking arm and investment banker, and the Fitch agency. These three are major global rating agencies that assess countries and companies and corporations and entities to assign their credit rating. And consequently, a lender would generally set a relatively low interest rate on a loan to a AAA entity. By contrast, a lower rated entity would generally have to pay higher rates of interest. I know it's a little bit weird. How can a company that is low rated, which symbolizes the fact that the company is, one that is struggling, than a well managed or a company with AAA rating, right? So you're basically adding more pressure, isn't that? But that is how banks work, right? And logically, when you think about it, it is a little bit weird. Or might struggle to raise debt finance at all if its ratings were especially low. This is because risk and return are always linked. If an investor is likely to face high risk, he demands a high return to compensate him for this risk, right? So higher risk, higher return, lower the risk, lower the return. That is the association between credit ratings and interest rates. As your credit rating goes down, the interest rate risk will be higher. And that brings me to this final but important component under debt financing, this option of leasing, right? The option of using an asset without really outright owning it. If an asset is needed for a major new investment, the asset can be leased. And then a critical decision is, should the asset be leased or should the asset be purchased? And the purchase cost financed by debt issue. In the exam, you may need to evaluate the lease against the borrowing to buy option to determine which would be better in financial terms, but that is more F3 OTQ related workings in terms of calculations. Here, lease versus buy, it's the idea that you always have these two options. So for the case study, you have to know how these options work and the fact that you have the options. But other than that, it's very unlikely you get to do NPV calculations to see if you buy the asset and generate revenue and all that, then what's the current net present value of that option, as opposed to you lease the asset where your initial investment is low, but you lease the asset in terms of regular payments, right? And you bring them into today's value, a present value. Then you match the present value or NPV of leasing versus the NPV of buying and determine how to go about it, right? That is lease versus buy evaluation. But be aware that these options are available for you. And in the case study, if you have to go for a major investment, and if it's an investment that can, and if leasing is an option, don't forget to evaluate that option as well, right, before you decide to buy. That marks the end of segment 2, financing, part 1, debt versus equity or sources of finance. Make sure that you keep working while having fun, and we will see each other in segment 2, part 2, which is dedicated to talking about capital structure, another interesting area. Thank you.